Attention homeowners, rising interest rates squeezing your finances? Well, you're not alone. Banks are playing it safe and withholding loans as much as possible. But that's leaving some homeowners tempted to tap their home equity to either venture into additional property investments or chip away at consumer debts. Financial guru Dave Ramsey sees a brewing storm, warning how it's just trading one financial stressor for another. He's seen the real estate game's dark side firsthand, and for those who are not ready to play, he has some alternative strategies to secure your financial future. So before you gamble on bricks and mortar, let's get Dave Ramsey's advice and recommended math for those who are eyeing the real estate market right now. Let's dive in. In times like this, make sure you watch out for some very questionable investing advice like this one.
Is this simply a rate story? Is that what makes real estate so attractive?
Well, I think it's primarily a rate story. And yes, I'm in Charlotte where the real estate is booming, so I might have a bias here. But, I think as the market eyes rate cuts, as Treasury yields come down, I think real estate could be an interesting play. And it goes back to that value I was talking about, Frank. I mean, real estate is trading at a 38 PE, which is, quite well below its 42, forward PE average over the past 5 years. And it's one of those sectors that could be in focus as the market turns more toward rate cuts.
Yeah, remember, that was coming from someone from eToro, an e-trading online company that benefits from people jumping into the market. They may not have their clients' best interest at heart, especially considering how they make more money with more transactions rather than the value that they give to their clients' portfolios. You know what I mean? Now, as for real estate, like with most investments, timing can be everything here. And from what I'm seeing, that timing would be not now. And this isn't just me talking. I'm sharing the words from Dave Ramsey. So Dave Ramsey, he's an American radio personality who offers financial advice. He's also written quite a few books, including the New York Times bestseller, The Total Money Makeover, and he hosted a television show on Fox Business from 2007 to 2010. His net worth is a very sizable $200 million. What Dave Ramsey is especially warning about is the craze people seem to be getting into, what he calls a stupid money move that could leave you without a home. And this is tapping into the equity of their homes in order to buy additional property or pay down consumer debts. This was with a call on air with a homeowner who was considering a home equity line of credit, a HELOC, to finance a down payment on another home. In Dave Ramsey's words, you're just trading one kind of stressor for another. Something that's particularly concerning in this high interest rate, high home prices environment, online search interest for HELOCs or home equity lines of credit reportedly hitting a record high earlier this year, and the number of applications followed suit, increasing by 13% in the second quarter of 2023, after declining for the previous 2 quarters, according to the real estate data firm Attom. So RubyHome, a luxury real estate brokerage, analyzed web traffic data, and they found that searches for the term HELOC were up almost 305% over the past year. So what's the big problem, right? Well, see, a HELOC would theoretically give you access to more capital, but, and here's the but, it's actually a big but, it also opens you up to some major risks as it's your home that's on the line. So consider your house like a big old piggy bank full of your home equity, which is the difference between what your house is worth and what you still owe in your mortgage. A HELOC allows you to tap into that piggy bank and borrow some of that equity, kind of like a credit card. Sounds great in theory, right? Well, here's the catch. One, HELOCs are secured loans, which means your house is collateral. Very different from credit cards. 2, HELOC interest rates can be variable, so your payments could go up or down over time. Now, according to Ramsey, they base those interest rates on whatever they feel like. It's completely variable and not indexed to some outside thing. Sure enough, recent data supports Dave Ramsey's objections. The average interest rate on a HELOC is about 10.02%, according to Bankrate, while an average 30-year fixed rate mortgage is currently sitting at 7.29%. And on top of that, there may be hidden fees with HELOCs that your lender doesn't necessarily disclose outright, like origination fees, annual fees, closing costs, yada, yada, yada. So in Dave Ramsey's opinion, taking out a HELOC is just like moving debt from one pile to another with a whole heck of a lot of risk. And it looks like a lot of Americans are taking on that risk. The latest analysis from LendingTree shows Americans collectively owe $349 billion on $13.1 million in HELOCs, and the average balance for a HELOC borrower is currently sitting at $26,702. And it's not as if HELOCs necessarily come cheaper than traditional mortgages. Personally, I think a lot of people are just kind of getting caught up in the buzz and the FOMO with mainstream media and real estate companies kind of hyping up the whole real estate market like they're getting paid to do it. Oh wait, They are getting paid to do it. One tactic that I personally know that they use is selling up foreclosure houses. Remember guys, not every house in foreclosure is a good deal. Pretty much like how not every car at a car auction is a good deal. You know what I'm saying? They're definitely mixing in some lemons in the bunch, if you know what I mean. With Americans accumulating massive debt through HELOCs, it's more important than ever to be informed about your financial decisions. So if you're considering a HELOC, weigh the risks carefully. And if you found this information helpful, then hit the like button and subscribe for more insights on managing your finances. All right, so let's get back to this one. So it's all connected, guys. We've been talking on the channel about homeowners' golden handcuffs, right? So basically getting those sub 5% interest rates, but also feeling locked into the mortgages because they can't find a better deal with interest rates and home prices where they're at right now. And of course, thanks to these locked in low mortgages, HELOCs are booming as a way to tap into their home equity. The trade-off? They get access to cash at higher interest rates, but they keep their sweet mortgage deal. Now, this strategy is not necessarily for everyone though. Some financial experts like Dave Ramsey advocating avoiding debt altogether. The goal for Ramsey is to be 100% debt-free. And for him, instead of figuring out a time when debt is okay, let's just figure out a way to avoid it altogether. And there's a whole group of homeowners who already own their homes outright. About 23% of homeowners in the United States own their property free and clear without any mortgage, giving them the freedom and flexibility that comes with being debt-free. Ultimately, it's about your personal financial goals and your risk tolerance. HELOCs can be a useful tool, but it's crucial to understand the potential downsides before diving in. Now, Dave Ramsey, real estate investments, especially for people struggling financially. His concern? Two key factors: the inherent risks of the market and, of course, the potential debt burden. One call he got in his show was from Anna, a Los Angeles real estate investor with 4 rental properties generating $50,000 annually, but also has a heavy $1 million mortgage. Now, as you can imagine, despite her success, Anna feels weighed down by the massive debt, something that she got through a home equity line of credit just to expand her investment portfolio. There's a lesson from Anna's story about how debt can overshadow even successful real estate ventures. Sure, there is some significant equity there. I mean, properties worth around $5 million isn't anything to scoff at, right? But then again, Anna herself admitted how the $1 million debt shackles her financially. And if you listen to Ramsey's show, you would see a lot of this. Real estate professionals who underestimate just how binding and restrictive the force of debt can be. So the message is clear. Real estate can be a path to wealth, but you need to be able to approach it in a sense of caution, especially if you're coming from a place of shaky finances. You know what I mean? Debt can quickly transform your dream investment into a financial nightmare. And Ramsey's focus is on escaping such nightmares, not building them. So for Anna's situation, Dave Ramsey recommended eliminating the debt, ditching the loans, and then focusing on expansion. He suggested that Anna use her income and strategically sell properties if needed to get debt free. Once that's achieved, it's all about cash purchases for future growth. No more borrowing allowed. Ramsey's priority: minimize risk, maximize security, and then consider expansion. See how this is counterintuitive to the current prevalent heavy borrowing for rapid growth mentality in real estate, particularly on platforms like TikTok, where pretty much people are overhyping their success stories to the point where they're already misleading their followers. This can definitely be misleading. Now, I totally agree with Dave Ramsey on this one. Entering a real estate market without a stable financial base is a recipe for trouble. Mortgage payments, taxes, maintenance, maybe HOA fees, repairs, these can quickly overwhelm those who don't have enough savings or income. I mean, the risk is real, guys. Missed payments, mounting debt, even foreclosure can turn the dream of home ownership into a financial nightmare. Get your financial house in order first, then and only then consider building your real estate empire on a foundation of stability and security. Now, I've personally heard way too many stories of people nearing retirement or already in retirement and they're very worried about their future with gas and food prices rising daily. These are the people who have had their savings dwindle with the cost of living in the stratosphere. I think you guys know what I'm talking about here. People who can get by, but they can't seem to get ahead. Honestly, I'm right here with you guys, especially to everyone who's retiring in this crisis. 30 years nonstop just for a crooked system to take all of what you've worked for, that's definitely something that keeps me up at night. Am I right, guys? And this is coming from a place of personal experience for Dave Ramsey. He's not ashamed to share his own youthful mistake of building a massive debt-fueled portfolio that crumbled under market pressure. That harsh lesson taught him the hard truth. Real estate is risky. and debt can be your worst enemy. So before you even think about mortgages, and I really can't stress this enough, get your finances in order. That means zero debt, a 3 to 6 month emergency fund, and a substantial down payment saved up. That way you can have a financial leg to stand on, a solid foundation that gives you the strength to handle the costs and the responsibilities of owning a home. Now, I mentioned Dave Ramsey's math for buying a house. So basically, Ramsey would love for you to buy your house with cash. Wouldn't we all, right? But that's not always realistic. So the next best thing, a smart mortgage. Steer clear of a low down payment, high interest mortgage. They seem appealing at first, but they can definitely get out of control down the line. Now, if you can manage it, slash the 30-year loan for a 15-year term instead. Why? Over the long run, you'll pay significantly less in interest. For example, a $175,000 30-year mortgage at 4% interest could cost you $68,000 more than the exact same loan with a 15-year term. That's a pretty big chunk of cash that you will be putting toward retirement, your kids' college, or simply just enjoying financial freedom. Now, we've all heard the rule. Your mortgage payment shouldn't be any more than 30% of your take-home pay. But for Ramsey, he recommends tightening that up even more to 25%. Anything higher can cripple your budget and make it difficult to manage other essential expenses and financial goals. Remember, a smaller, smarter mortgage means more breathing room in the long run. But I think Ramsey's message is pretty clear. Real estate can be a path to wealth, but only if you ditch the get-rich-quick mentality and approach it with financial prudence. Get your financial house in order first. Then, and only then, can you build your real estate dreams on a foundation of stability and security. But what about you guys? I'm also curious about your real estate stories, maybe even how you got yourself out of debt. Did you use the same approach as Dave Ramsey's? Share your stories, tips, and experiences in the comment section down below. We'll pick this up in a future video. I'll see you guys on the next one.